afternoon, everyone. Good morning, good evening, and good afternoon, everyone. Thank you for joining us for this webinar where we're going to talk about the very hot topic of SPACs. They seem to be all over the press, and there's a lot of information going on around them. But I think they're mostly unknown to a vast majority of people out there. And at least it took me a while to understand the SPACs, and I'm not even sure I fully understand them yet. So I'm happy to have around me three people who can hopefully help us better understand SPACs and their process. So, introducing you in alphabetical order, I have the pleasure of welcoming Angela Blateis, who's the co-CEO of TKB Critical Technologies. You're actually a listed SPAC, so would love to hear a little bit more about your background and how you went about that. I also have Gregory Poilâne, who's the chairman and CEO of Nuvve. You guys actually listed your company through a SPAC process and will bring that perspective to the table. And last but not least, Pierre Lapomme from BNP Paribas. You bring the perspective of the banker and all of the financial aspects of the process and the transaction. So the way I'm starting to understand it is that it's a fairly complex, if not very complex transaction with a lot of perspectives to be taken into account. It's different than a traditional listing process for a company. So what I'd love to do is, maybe first go around the table and have you guys give a 2-minute intro on your background so that the audience can better understand your perspective, and then kickstart with you, Pierre, maybe giving us some of the SPAC 101 that everybody should know before we head into the conversation. So Angela, if you want to get started.
Oh, okay, sure. Thank you, Reza. Thank you for having me. So my background, I'm Angela Blateis. My background is 30 years of investment banking and private equity experience, of which I did 17, almost 18 years leading M&A transactions for the Gores Group. I also helped them raise 3 of their funds, one of which I co-headed for 7 years. So anything to do with acquisitions, negotiations, structuring of complicated transactions domestically and internationally, carve-outs, taking companies public as exits are all part of my background. How I came into this, after leaving the Gores Group, my kids were getting older. I wanted to spend a little bit of time with them before I went off to college, and before they went off to college. And I didn't want to be back raising another fund, back on a treadmill where we had to do 4 to 7 transactions a year that were all cross collateralized. I'd known Philippe Tardival and Greg Klein, who are my partners, for 20 years, had tremendous respect for them. And we came together and wanted to do something together, but all felt that we really were passionate about our country. We were concerned about all the adversarial capital that was coming in and buying up our critical technologies. We wanted to make America a technology leader again. We wanted to make our country safe for our children. And we decided the best way to do it was to leverage our capital one deal at a time through a SPAC.
Great, thank you, Angela. Gregory, if I can ask you to go through the same intro.
Sure. Gregory Poilâne. I'm the chairman and CEO of Nuvve Corporation, Nuvve Holding Corporation now. I grew up in France, came to the US about 22 years ago. I initially worked in the telecommunication industry where I did a few startups. And then in 2010, that is when I started Nuvve, after I met with the Professor Willett Kempton at the University of Delaware, who had been working on a technology called vehicle to grid. The basic concept is basically using electric vehicles that have the capability of not just take energy from the grid, but also to push it back, to aggregate them all together and to basically make them look like big batteries. And therefore you can generate some revenue using those assets as you participate into a variety of energy markets with the vehicles while they are parked, right? I mean, when you buy cars, it's parked 95% of the time, where probably the worst investment we make in our life. And so that's really the basic concept, and now the way we've been going to market is by providing full turnkey solution, where we are providing the vehicle, the charging station, the grid upgrades, and we are able to provide that in a very attractive transportation as a service fee. And we can do that because while the vehicle are parked, we can increase the utilization and generate them some revenue. This is a market that's pretty new, but the awareness of EV integration is growing, and so this is really the opportunity that we have. And so we decided last August 2020 to go public through a SPAC, and we became a public company last March. We thought it was a good time for us to do that, and I'll go back into more detail about it. But we are very excited to be here today and to be able to share more about, as you said, a complex process, probably the most complex deal I've made in my life. But not from a negotiation perspective, just from the complexity of all the parts that you have to bring together in order to make it work. But again, very glad to be here today and to be able to share more about it.
Thank you, Gregory. And Pierre, last but not least.
Yeah, thank you. Hi, I'm Pierre Lapomme. I'm heading the BNP Paribas Equity Capital Market Group in New York. So typically, I've been in this business for 20 years, looking at IPOs, follow-ons, and having obviously been more and more working on SPAC in the past couple of years. Maybe, as you suggest, Riza, I can start by giving a little bit of a summary. Everybody said it's effectively a very complex situation with many features on terms, and it's still evolving. So I will try to make it simple. And sorry for the people which are already well aware of it, but I think it's maybe good to start from what is a SPAC. So what is a SPAC? It's typically a blank check investment company which get listed on raise dollars at the time of this listings. They are starting without having any pre-identified target company, but will have a certain time, typically 2 years. I mean, historically, it has been 2 years. Lately, it has been a little bit shorter of that, to acquire a business, generally a private company, to acquire target, or if they don't succeed in doing it in this time, to reimburse the shareholders. And so, some of the features of this IPO, I mean, typically what you put in on the market, it's units, which are a package of one share with a fraction of a warrant. And it's, again, negotiated terms. It can be half a warrant, a third, a fourth. I mean, depending on the time you're doing it. And generally, this amount which is raised in the IPO is put in a trust, and this cash will be used either at the time of the business combination, the merger, the acquisition, what we call a de-SPAC to make it simple. So it will be used to contribute to the merger on the target company, or it will be put aside to reimburse shareholders if the merger doesn't happen, or if shareholders are asking for the redemption at the time of the merger. The other aspect, which is generally, I mean, it's not an obligation, but it's generally associated to this SPAC, is what we call the PIPE money, the private placement of equity you have at the time of the merger. It's negotiated at the same time as the merger. It's generally the complement of equity infusion. You need to have the right amount of money to realize the acquisition, and to potentially have the cash to reimburse some of the shareholders we can ask for redemption at the time of the merger. So maybe the one way to also approach it is to look at what are the different stakeholders in a SPAC, de-SPAC transaction. On maybe we can put them in 4 categories. First, you have the sponsor, like Angela, which is typically individuals or institutions which have a special experience or access to an industry, and which are grouping together, forming the SPAC, and generally their experience will be used to source potential deals. Then you have the IPO investors, guys who will come at the time of the SPAC IPO, which, again, at the time of the IPO has no identified target, but generally has articulated a focus or strategy they will pursue. Lately, I would say these IPO investors have been mostly hedge funds, guys which are very interested by the features of a SPAC investment, which combine, a kind of protection of the principal because they can always choose to be reimbursed, on the upside of a successful merger, especially if it's well accepted by the market, where they can monetize either their shares or the warrants they have acquired at the time of the IPO. The third category is the PIPE investors who come later in the process, come at the de-SPAC time when an acquisition has been identified, on terms have been proposed, and will provide the additional capital which will help to realize this acquisition. Typically, these PIPE investors are traditional or more established institutions, not necessarily hedge fund. Sometimes you have a mix, but it's generally guys who will look at it like, what is the new proposal? What is the de-SPAC? What is the merge company? And will come on support the merger by providing some additional capital to it. The last part, and that's the part Gregory represents, is the target company, the one which will be acquired by the SPAC. It's generally a private companies or a division of a larger group, a business division of a larger group, which potentially will look at getting listed through the SPAC process. They see generally the SPAC, and Greg will certainly comment it more on the way to accelerating the listing process, and maybe securizing the terms of the listings through a valuation which is negotiated, not the traditional boat building. And generally, they look at maybe the de-SPAC as offering an avenue which is not necessarily offered by the traditional IPO process. Just a few statistics to give you. I mean, as we said, the SPAC is not necessarily a new structure. I mean, it exists, I think, since 2003 or something like that. But we have seen a real explosion of the activity lately. On the 1,200 SPAC which have listed in the US, half of them did their IPO in 2021. So you can see almost in the past 18 years in 2021, we've seen close to 600 US SPAC IPO in the US. So they raised just this year, 158 billion. That's represent, I mean, in terms of number of IPOs, it's 60% of all the IPOs in the US in 2021. And it's almost half of the amount raised by US IPOs this year. So it's pretty huge. And why now? Why this explosion now? Why it didn't happen, 5-10 years ago, even if you had some years when you had a decent activity in SPAC, but never to this extent? I think it's mostly due to the huge infusion of liquidity which has been put in the market, following COVID, and some of this money ended in institutions, especially hedge funds, with try to find a way to get a better yield than what the money market will propose. So they have a huge amount of cash and liquidity, and they think the SPAC, on some of them have been very successful in doing that, investing in a portfolio of SPAC or in individual SPAC, allows them to be at the same time protected on the principal, so preserving the cash if they need it, but also getting a tilt on an upside, a participation in the upside, if again the de-SPAC happen on a successful way. What are the today on it has been something which has changed a lot during the year, but what are, I would say, the challenge we see in the SPAC market today? First is the sheer size. I mean, you have today, I mean, I took the count this morning, 565 SPAC looking for an acquisition. It's certainly challenging to think that you will have as many eligible targets for them in the next 18-24 months. So you will have some competition for the eligible targets. On certainly some of these SPACs will not be able to find a good target. Second, as we mentioned, the PIPE money is not as available as the hedge fund IPO money. So you have few SPAC competing for a finite amount of pipe money, even if it's recycling. I mean, guys providing the SPAC being listed, and this guy having some liquidity available will certainly be available for new SPAC. But that's where we see a little bit of bottleneck lately in the SPAC market. On the third part, which is maybe less predictable, is the fact that the regulator are paying more and more attention, not too much at the IPO SPAC level, but more at the disclosure the different SPAC are making at the time of the merger, and especially how they use financial projection for justifying the terms of the merger. So that's the point which I will say are today in discussion on where we see an increase of scrutiny from the regulator, especially from the SEC. That, I think, in a nutshell, a little bit the introduction I wanted to make. I don't know if, Reza, you want me to address any other topic at this stage?
No, thank you very much, Pierre. This definitely sounds both, complex and exciting at the same time, like a fairly interesting process. So I'd love to dive a little bit into the process from different perspectives before I come back and ask you a few more questions on some of the data you gave. But this process overall seems super complex. So Angela, why did you go for this? Like, what made you wake up one morning and say, hey, I'm going to go tackle the regulator and build my SPAC?
Well, I think that the first thing is really understanding the complexity of the SPAC and really taking the time to research and think about why is a SPAC the right structure for our team, and what is it that we believe we need to put together in order to really be successful, because it's all about being successful in the end game. So the first key criteria was really the team. And for that, we wanted a team that had strong C-suite level operating expertise. The second thing was we wanted a team that had sector technology expertise. So in the specific sectors that we were going to attack, we wanted to make sure that we had that sort of expertise. The third is we wanted to make sure that our team was diversified enough that we could source the transactions, that we could navigate the complicated and volatile public market in order to execute a transaction. We wanted to make sure that we could fund a transaction. We wanted to make sure that our team could close a transaction, because that means you need public and private experience. You need experience with the IPO or the SPAC market. And most importantly, we needed a team that knew how to drive value, because raising the SPAC is only the first step. Closing the merger is only the second step. But you have to actually be able to exit your shares, which typically not only can you not do for the first year, but you can't do anything that's going to put downward pressure on the stock. So having an operating team that really knew how to drive value long-term and was really looking to create a viable asset where you added value was a huge differentiator for us. The second big thing was clearly articulating and understanding to everyone that was going to invest in the risk capital that we are not kidding. This is 100% at-risk capital. There is no guarantee for our risk capital investors, and we needed to raise $10.7 million. So they all needed to understand we wouldn't risk our own capital and our reputations if we didn't think we could be successful a year from the merger and navigate the 575 different SPACs that Pierre mentioned that we're competing with. So that's a huge thing. The next big thing is having the confidence that you can not only raise the risk capital, but you can raise the institutional money to get to the 200 million we were looking for, but also that you could compete in a SPAC off, not based on price. or that you had the ability to source proprietary deals and really drive value and create a $20 share price, a year and a half from the time that you close. The fourth thing we felt was really important in building a SPAC was making sure that we had a track record, that the ability not just to raise the risk capital, but again, to know how to invest that capital in a successful transaction and really drive value. And you do that by having the operating expertise to be able to challenge their vision, to lean in, and to make sure that their projections are not so lofty that they're going to create downward pressure on the stock 6 months to a year from now if they don't reach the multiples of compound annual growth that you're forecasting. And the last thing was really having the savvy and the experience to negotiate and navigate the complex market. So there's so many different nuances, but just in order to get anchors and to negotiate back-end funding, you're negotiating with Goliaths like Apollo Corporation or Atalaya, and they do huge transactions. And when it comes to the pipe or a convertible, you're going to be negotiating with BlackRock and Koch Industries, and they're incredibly sophisticated, and you need to understand what their terms mean and what they want, and have the ability to do that negotiation. And lastly on that point is the ability to really navigate the volatile markets during this entire time. Did you want me to talk about investor expectations or not yet?
Sure. I mean, you went at this. I mean, it's pretty clear why you're trying to do this. What are you expecting out of it? And then if I can get that more complete picture, then would love to then pass it on to Gregory and hear his perspective as the company who went through it.
Absolutely. Here's some simple terms. We thought we were going to have to raise 6.9 million of risk capital back in March of 2021 in order to get an IPO of 50 million that was trading publicly. That doesn't mean we make any money except for on paper, but that 6.9 million was going to go to 50. Okay, so that's pretty incredible, and that's at a $10 share price. And we then thought that our 20% that we own as a group of risk capital investors would then buy $1 billion company. So 200 times 5 to $1 billion, it means we would have 20%, we would have 80% dilution, and we would own a much smaller 5% of $1 billion company that we thought we could get to $20. That's pretty great math. When the markets changed and we were required in order to go forward to fund 10.75 million, we were able to fill our complete shoe because we were 5 times oversubscribed. So that 10.7 is worth 58.7 billion. And then if you're buying a company that's 5 times that and you get that to $20 a share, it's pretty attractive.
Got it. So there's basically a huge leveraged effect for you in terms of how far your money can go and as you're associating other people through the process. So I can totally understand that you get this multiplier effect, and that becomes very, very interesting for you. What happens if you don't find the company? Because Pierre at some point mentioned, that there's a limited amount of time for you to find the company. If you don't find the company, how do the economics go?
So it's actually even more limited than Pierre indicated, because in today's market and what it was 3 months ago when we were going out starting in August, and that's still true today, that 24-month timeline has gone closer to 15 months. You're seeing SPACs come out at 12 months. It's very hard to see anything come out at 18 months unless they're really giving up just a tremendous amount. You're even seeing rights, which is going to make it, on top of the warrants. So if you are not successful, you lose. Your 230 million is given back to every institutional investor, anybody that bought into the IPO day one or traded into it gets that money. Anybody in your risk capital pool, that 10.75 million, it's worth 0, and that's it. There is the ability to extend. You can extend a month at a time or 3 months at a time, and depending on the market and whether you've announced a deal and the appeal of the deal, it may or may not cost you more in order for that extension. So we went into this eyes wide open. I will say that the average time to close a transaction historically from the day that you announce to the time that you close is 9 months. So, and that's slowing because of the SEC process and the regulation and the ever-changing requirements that nobody knows. But you have to believe that you can execute, and there's no question that Pierre is right, that there will be a huge number of people that are not able to successfully close the target, and we hope and pray and believe that we won't be one of them.
Well, that's the worst we can wish you, Angela. I hope you will find. So Gregory, you're one of the, I would say, the happy few. You've found your match among all the hundreds of SPACs out there. So why did you choose to go to public markets this way, and kind of what was the give and take you went through in your mind deciding to go this route?
Yeah, I think so. I mean, from compared to Angela and Pierre, I'm going to give more of a in the tranche type of perspective, right? We were in the process of raising money, and our technology combined with infrastructure investments makes a lot of sense, and especially in the EV space, right? This combination of technology and infrastructure investment is really attractive in general to investors. And so we were talking to quite a few private equities about potentially investing in Nuvve and then supporting the some capital deployment through infrastructure. And as we were going through those discussions, it became very clear that if we were to close a deal with one of the private equity, then we would be kind of like married to that private equity, and we would never be. It would be hard for us potentially to even find an exit at some point. And so as we were working through the process, by the way, we were right in the middle of when COVID also started to hit, and for some time everybody ran away. Then everybody came back, and in the summer, in the beginning of the summer of 2020, we started to talk with some of the we had close relationships with analysts that are working on some of our partners, and so some of them put us in touch with the banking side and said, hey, maybe you should reconsider a SPAC because there's a lot of activity in that process. So that was again like July, and then in August of 2020 we started to look very closely to it. And the main reason to us was, one, we are convinced that the market we are in is gearing up for a very fast acceleration, and therefore one is the need for capital, two is potentially the growth in the valuation. We're both there at the same time, and then the choice of being kind of married to one private equity for the rest of the life of the company versus the ability of becoming a public company, yet still being able to build a relationship with potentially multiple private equity was something that was attractive for us, right? So the idea of remaining independent compared to financial partners that we are bringing was something that was attractive to us. And so that's really what led us to make that decision of going public, combination of fast market acceleration and kind of freedom in the growth of our business. By the way, so we worked on the process. We became public in March, and then actually a few months later, we announced actually the creation of a joint venture with Stonepeak Infrastructure, which is a very large private equity fund. And in this case, we also saw what was attractive for them to come with us is we were able to put together a joint venture that has $1 billion for capital deployment, 750 plus 250. And the way we made this deal work is by also sharing some upside into Nuvve through warrants and options that Stonepeak is getting as well. So we saw the strength that being a public company can bring to us in how we deal with partners and how it can help us really accelerate our business, not just in bringing capital to us, but also in, for example, creating legal mobility and this acceleration on the capital side. Now, it's not an easy process, right? We talked about the complexity on putting all the deal together. You are on my side, we were dealing with the SPAC team. We're also dealing with the PIPE investors. So it's really more like a three-way discussion. You have lawyers representing on each and every side. Probably the one of the most challenging thing, and especially for me, I've been CEO of private companies for many years, getting ready to become public, you have to go through a process where you need to audit your financial statements and having a PCB audit of your financial statements. It's a lot more complex, and there's a lot of exchange with the auditors. And so I think one of the good things we did there is to bring on board a CFO that had a lot of public company experience very early on. I think this was one of the most critical steps for us to be successful in doing this, so that we were kind of already working like a public company. We had to be ready with our PCAOB audits. And I think this was very important, recognizing that you have your range of experience. Let's make sure you bring the skill set that's going to help you go through the process. I think there was a big EV charging infrastructure company in Europe that actually failed in becoming public. And I think that their biggest issue was that they were never able to converge on the PCAOB audit. So this is obviously one of the most critical steps in the process. And usually everybody gets delayed, maybe 1 or 2 months because of that. In our case, we're 2 months behind in the process. Again, we started mid to late August. We signed the LOI. We became public in March 23rd of 2021, kind of a 9-month or so process, which I think is expected, or a bit less than 9 months. That sounds like a good timeline. You could maybe do it a bit faster than that, and then going public versus through IPO versus SPAC. I think like the choice there is really about we are in a growth market. We know the growth is happening. It's not just us, right? You've got all the big OEMs that are building electric vehicles. There is deadlines. 2035 is a big deadline for all the vehicles that are being built that are zero emission, most likely electric. So we are in this large ecosystem. And by the way, a lot of the 600 or so companies that went public through SPAC in 2021, a lot of them were into space, either battery companies, OEMs, and other type of EV infrastructure and supply chain companies in the EV space. And so really, right, you see this whole ecosystem that is growing, and that's why for us the SPAC was making more sense than IPO, because we were not shaped to go regular IPO. Because the growth is in front of us, right? Mm-hmm. I think IPO is like you've already been demonstrating that you have a strong business. SPAC is great if you are right at this inflection point. Timing of that inflection point is always difficult to get right. But here, because we are in this ecosystem that is accelerating altogether, we felt very confident that the timing was right. And it might shift 6 months, but we are right in the zone there. And so that's why that was one of the big reason why we made that choice. And just to close on these remarks, I think again the other thing is you come from being a private company and you become a public company. There's a lot of pitfalls, right? One, bring the right skill set on the finance side, on the IR side. Also, when you're working with VCs in general, you tend to be aggressive and say, hey, look at this beautiful forecast that I have for you, and then the VC is like, yeah, okay, I'm going to discount it by 75%. When you become public, you cannot do that, right? So you really need to change your mindset and come with very reasonable assumptions about the growth of your business. And we've seen, right? Some of them, are trading now at like $4, right? And that's because they were still in that mode of, look, we're going to do $120 million next year, and then 2 months later they come back and say, yeah, actually it'll be 10. That doesn't work. And either if you're going to set the expectation, you need to set the right expectation, but you don't have to. right? I mean, I think one of the, we are trading around $15 right now, which is okay compared to many of the other SPACs. It's really about building the relationship with the investors and setting up their expectations and sharing what you feel comfortable sharing. It's okay to not share everything because you don't have that resolution yet, right? They understand we are building a business. Revenue recognition is a challenge, and so at times, in our case, our business is very lumpy. Things happen in bulk. We recently announced, for example, our parking lot at Bluebird, which is a school bus manufacturer. We're going to deploy 400 charging stations there. And this is how you build this. You say, hey, this is what we are doing. These are the contracts that we are signing. And then you share metrics about how you build, how investors should be looking at the growth of your business. That's in your control. And I think that's important that you set up the right expectation if you want to be successful.
Got it. So if I kind of recap go ahead, Pierre, sorry.
Yeah, maybe just one comment on what Greg said. I think is very true. And you have seen in the past, I would say months, much more convergence between the traditional IPO process on communication and the de-SPAC, the listing through a SPAC acquisition. It's up to the point as a banker, as you can imagine, we're working on a lot of companies wanting to go public that now they go almost dual track. You see people saying, okay, I will have at the same time a parallel route where on the one hand, I will look at the traditional IPO process with the SEC filing and everything, but I will also, you have some overlap between the two processes, and I will also start a discussion with SPAC. Depending on the time, depending on where the market is, I can choose one or the other option, and I will see what is the best for my company. But it means they are structuring, they are structuring themselves as almost a traditional IPO process, because they know that, as Greg said, soon you will have to communicate, you will have to interact with the market and the regulators as a public company, and it will be similar process. So we've seen some bad story, I mean, one of them is well known. It's Nikola, which came to the market with some almost very misleading reportings on everything, on they paid a price. But you have also some companies which went through the de-SPAC process and are very successful, like the Greg's company. And so it's now a private company are really the choice between the two options, and depending on the time, depending on the specific characteristic, they will choose one or the other.
Got it. Yes, so that's what it seems I'm gathering from kind of some of the stats you've given in terms of how many SPACs are looking for targets. And it feels like from listening to you, Gregory, that depending on the private company's timing, a SPAC might be a better option compared to a traditional IPO. And some of the things you mentioned reminded me of IPOs in the biotech world compared to software, where biotech can go out and be publicly listed much earlier. But what might have seemed like a fast track in reality will have some of the same requirements in terms of seriousness and complexity and communication, et cetera. Otherwise, it's going to come back and bite you. But if I go back to some of your initial comments, Pierre, about 1,200 SPACs out there, 50% got listed in 2021. There's a whole bunch of SPACs, hundreds of them looking for targets right now. It feels like the private companies are the hotter commodity. So why so many SPACs listed just in 2021? What happened which kind of accelerated this process to this extent? And then B, how are the SPACs fighting for getting the targets? I mean, you said a lot of stuff are complex and negotiable. What's going on in the market recently, especially if some SPACs are trading way below, as Gregory seemed to point out? And just before you start, we'll open it up to public questions afterwards. So if you guys have any questions, please type them in the written Q&A box, and I will read from them afterwards. Yeah, thank you.
Yeah, I mean, you have effectively some SPAC or de-SPAC which have not been performing. You have some of them which have performed very well as well. I mean, I think Iridium, for example, has multiplied by 10. You know, I mean, you have some very successful story. I mean, you have a little bit of everything, like you have in the traditional IPO market. You have some IPOs which have performed superbly well, on some other which are definitively have more tough time. Why now? Why so many activity? First, understand that it has not been an easy path this year. We had tremendous activity in the first and second quarter, and it's almost shut down in the third quarter. Tremendous activity in the first quarter, and it's almost shut down at one point of SPAC IPO in the third quarter. So between the regulators, between the lack of available money, and now it's coming back in the past few weeks. I think the fourth quarter will be also quite active. So why now? I think first, just the fact that you have so many transactions that people start to be more comfortable with the structure, and you have more people looking at it, more sponsors, more, you know, it's becoming kind of more. It was in one of the obscure corner in the market until, you know, 4 or 5 years ago, and it's becoming much more. I mean, you see the headlines, and most of the people didn't hear about SPAC until 2 years ago, you know, and it's becoming more and more. I mean, in the mind of the public, it's becoming more legitimate. On I think it's that's, as I said also, you have a huge amount of liquidity in equity funds or in multi-strategy funds like hedge funds. And these guys today, if they have the choice between placing on money market at almost zero yield, or coming in a SPAC where their principal is guaranteed, but they have an uptick on the upside, you have a lot of money available for the IPO. I mean, they are now negotiating in the third quarter, and as Angela said to it, now the negotiation is a little bit more in their hands, so they have been able to reduce the size of the investment period. They have been able to get more yield through the trust. You know, they have been able to get more parity in the warrant, on getting also more of the sponsor economics interest in it. So the terms have been tilted toward IPO investors, but despite that, you've seen in the fourth quarter a lot of activity. So that's a little bit what is the environment today. Will the interest rates go up on the money market, yield more? Will this money will still be available for SPAC IPO and everything? I mean, it will depend on the magnitude of how much hedge fund can get as a yield for their cash available.
Got it.
I would just add to that there's a tremendous need for capital for these electric vehicles, for these cutting edge technologies. And it's just another path that accelerates companies that are otherwise in venture capital hands, raising Series A, Series B, Series C. And instead of really being able to focus on scaling their business and growing, every 3 or 6 months, they're focused on another fundraise and, you know, doing a road show, and it makes it very hard to pick their projections. So I would say that that in terms of the complexities of what it's like post IPO combination or post IPO, the challenges and requirements and reporting requirements are identical. The difference is if you have good SPAC sponsors, they'll make sure that you have the proper underwriters to support the stock. They'll make sure that you've got the right researchers to support the SPAC, and you'll make sure that they're properly capitalized so that they have the ability to have that capital to reach their money, to reach their vision, whatever capital is it that you've determined together that's necessary. And lastly, just having that institutional support to make them public ready, to help them achieve that scale, because not all of these entrepreneurs have had the ability to actually scale anything from, you know, 20 million in revenue to $1 billion. So I think those are all really important. And just in case I don't get a chance after this, I just want to say, if anybody that's in the audience knows of any companies that want to accelerate the process of going public and believe they're a good SPAC candidate with 700 million enterprise value, up to several billion, that really think they're cutting edge technologies that are critical, and that are potentially looking to go public through a SPAC, we pay really attractive finder's fees. So send them my way.
Ooh, I'm sure we will, absolutely, Angela. But actually, let me ask you this question related to the comment you just made. If I take Gregory's company, who was not in full revenue, blown and scale, as he was mentioning it a little bit earlier, how do you determine the enterprise value? Are you going back to the venture capital methodology of valuation as opposed to the more standard multiples on revenue that public markets use?
It's a combination of both, right? So in every typical analysis, you use a discounted cash flow analysis, which is much more challenging when a company's not going to have EBITDA for 3 or 4 or 5 years. So when you have companies that that are really banking on the future, what you want to do is, and it's if you have a company with 100+ million in revenue and you have huge growth, you can look at other companies out there, what they're trading at, from a multiple of EBITDA or multiple of revenue, and then you can compare their gross margins to what the gross margins your company has and their growth rate to what you have, and you can make some up or downs. In a market where you're really banking on the future, we happen to be looking at something that may be interesting, and that has relatively low revenues for the first quarter ever, this fourth quarter of 2021, and they're going from almost nothing to 100 million by next year. So what's important to us is really validating that their technology is as unique as they say it is, being able to talk to the customers that they have and really do that important due diligence and really pressure test their ability to scale. Do they have the people? Do they have the infrastructure? Do they have the relationships? Are those achievable? What we're looking at when we're looking at what that valuation might be is a combination of things. So we're looking at, with the help of our underwriters, companies that seem to be relatively competitive in terms of high growth in that space, what those margins are. We're looking at where they're trading now. We're looking at where they're trading relative to their 2021 is over. So people are looking at 2022, 2023, and 2024, what they're looking at and where those values are as multiples of revenue. So we're looking at all those different things, and when it will be profitable and discounting that back.
Got it. So Gregory, this is kind of, you mentioned once you're public now, you're subject to the same, basically rigor of public markets. And that's kind of a big leap from your private times. And you had longer development cycles because of what you were doing. How is that pressure on the company? How are you guys, just beyond you, the whole organization, living now the fact that they have to report quarterly and they're now being, held to much tighter standards as opposed to, a year ago when you were still mostly in development mode and building the company?
Yeah, I mean, that's why you need a team that has the experience in doing that, right? You still have to take care of your business and get the company to grow. So you don't want to dive into that, right? So there are experts there, right? So I mean, you need the chair of your audit committee to be a high profile. In this case, David Sherman. He's a professor at Northeastern University. He's the chair of our audit committee. You want a CFO that has a lot of public company experience dealing with the auditors. You want to have somebody that's going to be in charge of all the SEC filing and all of that. And so that's where, becoming a public company, your expenses are going higher, right? You have to face that reality that we haven't talked about. That there's a price to it, which is your expenses are going higher. Your D&O insurance, especially in this environment of many SPACs and a lot of lawsuits, shareholder lawsuits, when on some of those things, the way some of those SPACs have handled things, then for everybody the cost of the insurance goes up, and so you need to be ready for that. You need to account for it, that you're going to have a higher cost. But this is where also then you need to look at it and say, hey, I've done all this effort now, I'm there. And now you also have a much broader range of potential growth outcome, right? You can still be very focused on being organic, but also now you can seriously look at acquisition that you can do that are going to allow you to go faster. So I think that you need to understand the constraint that you create to yourself, the cost increase that you create to yourself, but also why you did it and the upside that it's providing to you, and how you can accelerate yourself in becoming, in growing your company. And I think it's important to, I think this is maybe what also Angela was saying, is the mindset as the leader of this organization needs to change, right? You went from being a private company where you have to deal with investors and you go on roadshows, and in this case you need one win and you bring some cash. Now you talk to investors on a very regular basis, and some of them are very aware of your business, some of them are just discovering it. So you need to really have improve and in all those dimensions that are putting your company to the outward, because that's the way you're gonna make people understand your core business and help them to better understand also how they can see your growth, so that they understand what that this is a great opportunity and that they should be putting more money into your business.
I wanted to add one thing to what Gregory said, if I may, and that's that it's, if you don't have to raise capital every 3 to 6 months and you're trying to be a fast growing small business, and somebody that you're competing with gets a pot of gold, it's very hard for you to compete. And so you're seeing companies that are VC owned coming to market much faster and earlier than they would have, because it becomes an offensive play. If you don't do it, you can't compete the same way. And I'm sure you're experiencing this, Gregory. You have a much better ability to compete when you've got that money and you don't have to worry about fundraising. You can just focus 100% on your business.
Yeah, and then I think something else that we see is some companies are hesitating, or maybe they are not ready to go through a SPAC, or maybe their investors are afraid of doing it, or so could be many reasons why. But I think along the line you're saying, Angela, is I think those companies are at risk because the overall all the other ones are just accelerating so fast, and these ones are being starving for cash. In a business like ours around electric vehicle infrastructure rollout, at this point, it's a hyper growth market, right? You want to sign contracts, sign. That's what you need to do. And so running for capital at the same time as you're doing that is just going to slow down your business. So I agree 100%. That's why going back to the timing is essential, right? You need to be right at this inflection point, and then that's the perfect timing to go public through a SPAC.
But I would, just add to what you guys are saying, that the same is true now going down in venture stages, right? And, we're seeing more and more money being poured at earlier and earlier stages in the venture capital world, where it seems like, back to some of Pierre's comment, the interest rates are low, a lot of money is pouring into private equity, and then basically people are now coming in putting a lot more money at earlier stages, and companies are justifying it by the need to go faster and faster and be able to invest. So it feels like that whole pressure is on the complete ecosystem anyways. So Pierre, we have a couple minutes left here. What, if you look in the crystal ball, how do you see this market over the next few years? Is this, a fad where nothing really happened for years, everything happened in 2021, and then maybe some will happen in 2022 and then it will go away? Or do you think this is going to be a long-term alternative to a classic IPO with just attracting a very different set of players, and there will be the two avenues in parallel for the foreseeable future?
Yeah, first piece of information. You have 280 SPAC in registration for an IPO today. So in addition of the 600 who went public this year, you have almost already 280 which have been announced, publicly listed, filed with the SEC to go public. So we are not short of supply of new SPAC as long as the market effectively accepts it. My belief, and again, it's a crystal ball. It's part of the environment. It will be part for the environment now. It's a new tools in the toolkit, of how a private company can go public. I don't think it will be at the level of what we have seen because, again, we were in exceptional condition in terms of liquidity available on kind of the new concept and everything. We've seen over the year people are becoming a little bit more realistic as well. It's not a silver bullet. As Greg said, it doesn't save you from doing all you have to do to prepare yourself to be public. You are basically, it's not easier or it's not less demanding than becoming public. So depending on the phase, the time, the cycle, it will be the best solution, or it will be more difficult. We have a mixed outcome. You have some companies which have been extremely successful, and clearly the SPAC helps them to accelerate their development. You have also some bad stories. People either not performing or having misled the market on paying the price after that. I think it will be more regulated, certainly on somewhere. We are welcoming it because as it will be more regulated, it will also be more institutionalized. You will have more, it will be a real compartment of the market. But yeah, definitively, it's one of the new solution, I would say, in the toolkit of how a company can go public. And depending on the time, on the circumstance, it will be a superior solution to the traditional IPO. But in some other case, the traditional IPO will stay. And again, we are involved in many dual track process, and I can tell you a story about companies who went first de-SPAC and were not successful, not able to complete. We haven't seen some announced de-SPAC who were not able to go up to the end and who have to stop the process, despite the fact that it was publicly announced, because between the announcement and the regulatory closing, you have 4 or 5 months. So you're in market risk. You're in the risk that the company cannot be successful, and you're in the risk that the money will ride up. So it's becoming. I think people are much more eyes open about what is the process, and it has some pros and some cons. And depending on the circumstance, you will elect to do it this way, or you will go the traditional way, knowing that you can also go direct listing. You have much more optionality, I would say, in the IPO, in the getting public process for private companies. One aspect also, it's becoming more international. We are seeing more SPAC IPOs in Europe. It's minimum to the extent of the US. It's not 600 new IPO in Europe, but we are starting to see more and more activity in Europe. I haven't seen really Asian listed SPAC yet. We've seen a lot of US SPAC saying that their target will be in the region, in APAC, or they can choose the region, but I haven't seen really a domestic SPAC market in Asia. But I think at one point it will come. It's just the nature of the structure.
Great. Well, we're out of time. I want to thank the three of you very much for participating here. It was great to have the perspectives on all sides of the equation here. The banker's perspective, those who are raising the SPAC, and those who are going public through the SPAC. It seems like this is definitely here to stay, and as a parallel environment than a traditional IPO. To Pierre's point, I think the more regulation scrutiny, the better it is at the end of the day for the market, because it will be less faulty, and people will feel more comfortable investing in them and going public through them. Angela, thank you. I wish you the best of luck in finding a company that you can de-SPAC through the process. Gregory, thank you as well, and congratulations on your public listing. I hope this will allow you to get all the investments you need to continue growing and dominating your market. And Pierre, thank you very much. I hope you can have many successful SPACs and de-SPACs on your chessboard here and accompany people the right way. Thank you very much. Thanks a lot and have a great day, everyone.
Thank you.
Thank you.
So
Bye-bye.
much.
Thank you.
Okay,
Thanks, bye.
Bye.